Some of you are going, yeah, I want to do some charitable giving, but I just don't know. Does it benefit me? I know there's a tax purpose, but I don't really know. Let's take a hypothetical, because I did this for a client literally like 2 days ago. So what happened is a client came to me. They're like, hey, all right, I want to do charitable giving, but I'm not a huge giver. I'm not saying that because I'm a bad guy. I give in other ways. I'd rather volunteer my time and other things. I say, fine. They say, here's what I want you to know, though. I want you to know that if there's a tax thing that I should be doing and I'm not doing it right now, I need you to tell me. I said, okay, here's what I want you to think through. Let's assume that you're taking the standard deduction, which, by the way, is $29,200 if married, filing jointly, okay? $14,600 if you're single, but married, filing jointly, $29,200. That's your standard deduction. So every single year you can take a standard deduction or itemize. You want to itemize if that number is greater. So mortgage interest and other expenses and deductions, and you ask yourself, what is going to save me more in taxes to get to your taxable income? So the reason I'm giving you this example is let's pretend that you right now, I want you to paint yourself in this picture. Let's assume you right now are giving $5,000 to the Red Cross, okay? You're doing it every single year for 10 years, okay? $5,000, 10 years. You just gave them $50,000 of your hard-earned cash, but it's for a good cause and happy days, okay? So that's option one. The thing is, remember, why are you doing this? So $5,000, and you're taking the standard deduction, which means you're not actually getting a tax benefit. You're just being a nice guy, and you're giving $5,000 to the Red Cross. No problem there. But what if you did this instead? What if instead you looked in your brokerage account and you saw you had Apple stock, and Apple stock's done really well for you, and you bought it for $10,000, but now it's worth $50,000. Okay, it's a $40,000 gain. Well, now what you can do is, as opposed to taking $5,000 and giving it to the Red Cross every year for 10 years and getting no tax benefit, what you do instead is you take the $10,000 you bought Apple stock for, which grew to $50,000, you move that to a donor advised fund. So now all you're doing is you're moving this position in your brokerage account, a very highly appreciated position, which means it's done really well. $50,000 goes to this foundation. And the benefit is it now goes to this donor advised fund. That's like your own foundation. It's like your own giving fund. And that can continue to grow for you, meaning you can keep investing in Apple stock or a different mutual fund or whatever you want. And that's going to keep growing, and you can gift from there. So what that means is you can take $50,000. That's it. You just remember, you took $50,000 from your brokerage account. It's now in your donor advised fund. So Ari now has a donor advised fund with $50,000. And now I'm going to give $5,000 every single year to the Red Cross. So let's assume my $50,000 grows by 5%. Great. Then just the earnings are sent to Red Cross. And here's why it's good for you. When you do that gift to the donor advised fund, that's a 1-year $50,000 deduction. So as opposed to doing $5,000 every year for 10 years, do one big deduction. So you get a $50,000 deduction in 1 year. That's great for your tax plan because you save a ton in taxes. Maybe at the same time you do a Roth conversion. You're like, whoa, Ari, what are you saying here? What I'm saying is you can do a big deduction in 1 year and do a big Roth conversion in 1 year, and they could offset one another. So you don't have to pay a ton in taxes on the Roth conversion because you have this big deduction. Now, don't just go do this for the sake of doing it, but some of you are going, hey, is this like a tax brain, or is this going to put more money in my pocket? And I'll say, it depends. Let's quantify it for you. How big of a gain do you have? But think about it like this. It's better to do it this way, because if you were going to take, let's assume you were to sell Apple stock, okay? And it's long-term capital gains, 15% on that. I'm just doing this with you. You're just taking 15% on just the gains, okay? Not on the principal. That's $6,000. So $6,000 is what you have to pay in taxes. So now at the end of the day, yep, you have your $50,000, but you just paid $6,000 in taxes. So really $44,000 is what you have. And now you can go give that to the Red Cross or to whatever foundation you want, as opposed to moving that money to a donor advised fund and gifting from there, saving you $6,000 in taxes. You're not coming out of pocket paying taxes and then gifting. You are directly moving the funds to a donor advised fund, and that fund is gifting. So it benefits you for tax purposes, and more goes to the charity, because if you did it the other way, you'd say, well, Apple stock, I've only got $44,000. Here's 44 versus, do I give a certain amount every year? So hopefully you just saw the benefits of charitable planning. Okay. That's just one example. And if you want to do any of this, end of the year is the time to do it, okay? There's a whole lot